Welcome to the weekly recap, brought to you by themortgagereal.com for the week ending January 23rd. Not only a historic week, obviously, for the United States, but also for the world, as the first voted in African American president, 44th president of the United States, Barack Obama, was sworn into office. After the celebrations had settled out, we quickly returned back to reality of the marketplace. And it especially hit home today being Friday. For the first time, Frederic Mishkin, one of the Federal Reserve chairmen, announced today that the I word is coming back into concern, and meaning inflation. Now, this is a little bit mystifying to a lot of the marketplace, but it does raise a concern that we want to address to all of you, the viewers, current and future home buyers. With inflation returning, this does cut short our refinance opportunity and the opportunity to buy at significantly lowered rates. Now, how does this really translate? We obviously know that the government has this $500 billion initiative that goes until June. But here are some things of the economic recovery starting to take its foothold. We are now seeing the stimulus packages starting to unveil and make a difference. We're also seeing corporate earnings and the job cuttings going to start to transition into earnings. The cost cuttings turning into earnings. There are several things that are coming into place that are resulting into some positive outlooks coming for the later months of this year. Not that the market's going to come in a robust boom back, but what we're waiting for is that market to settle. And for the first time, these signs are starting to show. And with the concern of that is if the economy begins to go back into inflationary mode, they're going to have to do something with interest rates. Once this $500 billion is used up, then there's no more initiative for them to buy mortgage-backed securities. So if there's not as much being purchased, now what happens to supply and demand? In those yields on the mortgage-backed securities are going to start to increase. And that's the fear now, especially since the word inflation was used. Oil prices are obviously another concern, and this is what leads to the worries of inflation. Going into the summer months, increased travel, increased commuting, just a whole number of contributing factors that spiked the demand of oil, also increasing those prices, driving us into an inflationary mode. That is total 180 of where we're at today, and it's hard to imagine going back to those times, but it is a brutal reality that we must face. Now, really, where does this come into play with mortgage-backed securities? Right now, the Federal Reserve has already purchased about 10%, which is $52 billion of their total $500 billion package. Now, that leaves about $450 billion between now, January 23rd, until June 2009 to be used up. We want to replay this as how, again, this is going to impact interest rates. If this money is no longer available and it's no longer being purchased, yields have to go up. A lot of lending companies are making the statement that these rates are going to stay for this year going into 2010. You have to heed the warnings here. Inflation has been brought up again. It was mentioned on CNBC early this morning, and it will continue to be brought up. Now, let's go back in history. As the word deflation came into play, they started to talk about it more and more, and gas prices came down. Media is a big contributor to this because then as commodities sold off, oil being one of those commodities, we saw the price per barrel come down, and for us, gas relief at the pump came down. Now, let's think about what media does. If they talk about inflation, and they start talking about how summer months people travel, and then if Wall Street starts reacting to this, and they start purchasing these commodities, being futures of oil, and those contracts, these commodities start rising in prices, and the contracts expiring start increasing in purchases, then those yields will go up, and the price per barrel will go up, costing us at the end user at the gas pump to go up. That is inflation, and that's the concern. Should that happen, how the feds are going to counteract that is to start increasing interest rates. Because if they do that, it'll slow the economy down, because the end user, us, the homeowners, future homeowners, the public, mainstream, can't afford that right now with deflation so severe, with the recession still here. Now, those two numbers are definitely like oil and water. They just don't mix. Inflation and deflation can't go together at the same time. But this is the only strategy that the Fed has to use to fight that inflationary period. And to keep gas from really going out of control, to keep inflation from going out of control, they're going to have to raise those short-term interest rates. Anyone who has a home equity line of credit, that prime index rate will go up. Your variable adjustable rate mortgage will go up. Anything that's not on a fixed rate will go up. Just as fast as it came down in 2009, in 2010, if the word inflation stays, you'll see it go up. So right now, it is very crucial to get your applications in. Even if you're not 100% committed to refinancing, even if you're not 100% committed to purchasing a home, it's the best time to get your applications in and get the process started. So that what happens? Once this thing comes to a final, and these words start to be used more and more in the media, inflation, 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 you can't wait until that point to say, I want to start now, because the market is going to be in a massive induction into the mortgage world, and applications are going to be all-time highs, and people are going to be fearful that they lost a refinance opportunity from this refinance quote-unquote boom. The boom is going to be very short-lived should this summer play out the way that the Feds are anticipating now that they've talked about it. So internally, they're slowly releasing this information. We want to make sure you have a clear understanding. If inflation does kick in, interest rates will inevitably go up. That is unfortunately bad news for these low rates. So key time to get your applications in, get your process started. If you're on an adjustable rate mortgage, you're liking it right now because interest rates are low, heed the warnings. Get into a fixed rate as quickly as possible. We can't stress that enough. If you have any questions at all, because this is going to raise a lot of discussion, please feel free to blog below or contact us at info@themortgagereal.com. We'll talk to you soon.